Hello and welcome to Podcast.init, the podcast about Python and the people who make it great. When you're ready to launch your next app or want to try a project you hear about on the show, you'll need somewhere to deploy it, so take a look at our friends over at Linode. With the launch of their managed Kubernetes platform, it's easy to get started with the next generation of deployment and scaling, powered by the battle-tested Linode platform, including simple pricing, node balancers, 40 gigabit networking, dedicated CPU and GPU instances, and worldwide data centers. Go to pythonpodcast.com/Linode, that's Linode, today and get a $100 credit to try out a Kubernetes cluster of your own. And don't forget to thank them for their continued support of this show. Your host, as usual, is Tobias Macey, and today I'm interviewing Paul Stafford about building risk models to guard against financial exchange rate volatility. So, Paul, can you start by introducing yourself?
Yeah, Paul Stafford. I'm the CTO of Diaglo Partners, LLC, and we specialize in helping corporates and funds manage their FX risk.
And do you remember how you first got introduced to Python?
It was probably about 3 or 4 years ago when I was developing a number of algorithms for some corporates I was working with. And back when I was at HP, I was working in C and C++, and when I started to look around, those seemed to be on the decline, and Python kind of popped up as one of the more popular things. And what got me excited was that it was like all these free and open IDEs and tons of exciting libraries. So yeah, it seemed like an obvious choice.
And so digging into the idea of risk management, and I know that you're working in particular in the financial exchange space, I'm wondering if you can just give some of the overall principles involved in risk management and some of the statistical methods and algorithms that are typically used for that space.
Yeah, sure. So I'm going to start off by kind of giving an example of where FX risk pops up, just to kind of people get their minds around it. So let's say you're an investment fund based in Brazil and you're looking for U.S. investors. So they're going to send their dollars to you. They're going to get converted to reais. They'll be deployed in country. 2 or 3 years later, those reais need to get converted back to dollars. In the meantime, if reais has depreciated against the dollar, healthy returns can get chewed away or even completely eliminated by spot rates changing. So that's where the risk arises. With corporates, it's kind of similar. If you've got sales in another country in their local currency, the revenues in that country, when translated back to your reporting currency, can easily not meet your metrics and expectations. And so managing that risk becomes very important for those groups. In terms of principles, the first thing basically is to look at quantifying risk. And this is where things already kind of get funky because, finance is full of ex-physicists and math guys that tend to apply real world rules to finance, which is not driven by real world, is driven by people, and so, but we do tend to start off by modeling everything with, normal curves and distributions and that sort of thing. And so basically, when you create a model where like spot rate is modeled with a normal and a variance, then you can use things like VAR, value at risk, which basically looks at the worst case of how much you could lose with a certain amount of confidence. And another one which kind of complements that is something called expected shortfall, which is all of the tail risk netted together.
I know that there are also a number of other domains for risk management. So the most obvious one would be in the sort of insurance and underwriting case, or where you have actuaries who are determining, what is the probability of some certain, event happening that is going to require us to actually pay out this insurance rate. But then there are also other elements of risk. And I'm wondering how much of the kind of modeling and mathematical aspects of those risk calculations are universal across the space and how much of it is specific to a given domain that you might be working in.
I would say insurance is a completely different domain, because basically you're looking at rare occurrences. Whereas if you look at, say, selling or buying a stock or exchanging currencies, the risk is evident every single day because the rates are changing in FX and, stocks are going up and down every single day. And so the ways that you model those risks are quite different than an actuary would.
In terms of your involvement in the FX market, I know that you started your career as a scientist working with NASA and then moving on to HP. I'm wondering what your motivation was and your path from the more sort of hard science and engineering space into the financial markets and some of the ways that that background in engineering has benefited you in this new domain.
So how did I get over to the dark side? Is that the question? Yes.
More or less, sure.
Okay, yeah. So, it's funny. About 12 years ago, a friend of mine, somebody we call a high net worth individual, was speculating in currencies. And he actually asked me about how he might manage his risk when doing so. And that was the rabbit hole I plunged down. It was infinite, deep, and interesting. And I never climbed back out, looking at the tools, the derivatives that are available, how those derivatives are created and modeled and priced. It was actually, there's this whole new world, but it was mathematically based, right? I mean, Black-Scholes equations for options and differential interest rates and such. And so it was fairly straightforward to get a grip on how the whole system was put together. On that risk management note, I basically decided to look at what I could do for firms here in Montana, looked at the Montana World Trade Center, reached out, and led me to create my own advisory, which I cleverly named Currency Risk Management. Everybody makes fun of it, but it did help with SEO.
Yeah.
Yeah. Something so obvious, right? Anyway, so, and then you asked about background. So, I think that, having started off in science and engineering, it all kind of comes down to maths, basically, in particular linear algebra. There are concepts that you see in finance called PCA, right? Principal component analysis. But when you dig underneath the hood, that's really just eigenvector, eigenvalue decompositions. So they give funny names to stuff that we're all familiar with in linear algebra. The other thing that I get to use a lot is vector calculus, because I'm working with volatility surfaces and exploring gradients and such to optimize option strategies. And so I would say that, maths is probably the most important tool to bring into finance, and it prepares you pretty well for managing all that. And then, of course, programming and modeling systems on top of that.
Yeah, just briefly keying off of your note about being good for SEO, that's essentially where I ended up with my other podcast, the data engineering podcast, that does what it says on the tin.
Exactly, right? Everybody laughs at it, but, I came top of the list in a lot of searches, so it worked out well.
Absolutely. And so in terms of the specifics of the sort of tools and mathematical principles, you mentioned a few things already with sort of eigenvectors, eigenvalues, and vectors working in linear algebra. But what are some of the methods and techniques and some of the specifics as far as the programming aspect that has been particularly useful in your career and risk management?
I would say that, the most useful thing has been Markov chain Monte Carlo simulations. Basically, one of the big things that we bring to our clients that many other players in the space do not, is a grip on all of the potential outcomes. So, for example, if a bank is going to be presenting an option strategy to a client, they'll show them a payoff diagram. It's like, if the spot rate is this, you'll get this much. If it's this much, you lose this much, blah, blah, blah. But they never once talk about what the likelihood is of any one of those spots actually happening, right? And so you have no idea whether you're most likely to get a payoff or most likely to get a kick in the butt. Where a simulation, and you plot, the distributions of the outcomes, in either a box plot or a violin plot or something like that, and you plot that against, say, 3 or 4 different strategies that banks have given you, now you have a visual tool to compare the efficacy of those against the unhedged exposure, right? I mean, that's always a choice, is to run unhedged, to not manage the risk. And depending upon the cost of the derivatives you're working with, that's always an alternative. So I would say that that's probably the biggest one. And I've spent quite a while building simulation engines that allow me to vary the volatility, the skew, to give it fat tails, kurtosis, for example. So we've got a lot of levers to pull, and then able to simulate a lot of different types of markets, different types of dislocations, so that we can see how all of these strategies hold up under some real tests. Kind of the other tools use a bit of classification tools like SGD and SVC. Those are probably the biggest ones. I use, obviously, all of the Python libraries. Scikit-learn and SciPy are probably the biggest ones that, outside of the normal NumPy and Pandas stuff that I use.
You mentioned the Markov chain Monte Carlo. I'm wondering if you have used the PyMC3 library at all for being able to build out some of those simulations.
No, I built my own before I knew that existed. The Python libraries are so extensive. I'm sure there's a library for everything. In fact, I just discovered one for astronomy the other day, which was pretty exciting, but did not know about that. And I thought actually after you mentioned that PyMC3 is mainly about using Bayesian statistics. Yeah, so that is not part of what I'm talking about here.
In terms of the sort of mathematical approaches, a lot of what we're discussing is sort of well-known statistical methods that are sort of classically applied and, theoretically can be calculated by hand, although it's going to be very tedious and time-consuming. But I'm wondering how recent trends in terms of the more widespread adoption of deep learning and deep neural networks have impacted the sort of capabilities and strategies around risk calculation and being able to apply those to the foreign exchange market?
Yeah, so that's a great question and kind of multiple bits of answers there. So to be honest, I've played with neural networks and deep learning only a little. And the reason is that their application in this space would be in a predictive manner. So for example, you might take a bunch of different macro factors, like GDP and unemployment and, inflation and stuff, and see what kind of predictive power they have in terms of where spot rates might be going. If you're an investment firm, that's a fine thing to do. But if you're a risk manager, that's a dangerous as hell thing to do, especially because, as we all know, neural networks are impenetrable, right? You can't explain how it got to its answer, right? It just did. And so I've done very little of that. The main tools that I've been using are Bayesian regressions and constrained optimization, because typical things that I'm doing are to, for example, identify a proxy currency. If you have a currency like, say, the Argentinian peso, which, is, if you follow any kind of world events, Argentina is kind of a mess economically and has been for like 50 years. And there's no derivatives, no spot rate. No, it's a disastrous market. But people still need to do business there. And so if you can identify a basket of currencies that behave similarly but have liquid markets and derivatives, then you can substitute those and protect yourself. And so those are the approaches that I've been taking to this sort of thing. But yeah, the predictive stuff is not in the risk manager's toolbox.
In terms of being able to accurately calculate and understand the risk that you're working with, obviously you're going to need to have high quality and trustworthy data to be able to inform your decisions and inform the way that you are thinking about how to mitigate the risks that you and your clients are taking on. And I'm wondering how you handle sort of validating the inputs that you're using for these different statistical methods and being able to sort of identify what are the sort of most important attributes in the data that you're working with. Obviously you have the concrete data from the different financial exchange markets, but I'm sure that there are also other external factors and secondary data sources that you're dealing with, and just how you're able to synthesize that into a meaningful risk assessment.
I'm going to have to disappoint you. All the data that I work with is easily obtained and validated. Basically, we are using historical spot rates, derivative, premiums, forward points, all those sorts of things. Like I said, the other data, like macro data, is extremely hard to come by in a timely manner. I actually looked at this a few years ago to see if I could do some sort of predictive stuff. And, basically I was pulling down the kind of macro data that I mentioned, a minute ago. And what I found was that it was very problematic. It's delayed, number one. I mean, you can't get this month's GDP, on any country, right? You're going to have to wait 3 months. And so it's highly delayed, and there's a lot of missing data, and they don't seem to give a shit about it. And there's no way, I suppose that you could, fill, using some sort of an interpolation algorithm, but, that is also fraught with its own issues. So from the standpoint of what I'm doing, about the only thing that is variable and difficult to predict or find good data on is the price that you pay for various derivatives is opaque. It's what's called an over-the-counter market, OTC. And so, the banks can charge whatever kinds of spreads they want, and that can be quite variable. And so if you create like a rolling hedge strategy, like say you've got event that you're hedging against that's 5 years from now. There are no derivatives that go out 5 years. So you have to hedge out 1 year and then a year from now, roll it again, and a year from then, roll it again. And knowing the costs of those rolls is impossible, right? You have to do kind of a statistical distribution on what bank spreads are going to be and how liquid the market is going to be at that time. So that's the data that's hard to find or hard to come by. But I don't deal with the macro data in our business.
Obviously, one of the sort of most unpredictable elements of financial markets and world markets in general is the recent pandemic. And I'm wondering how that has influenced your overall sort of strategies, or if you've had to sort of tune or update your algorithmic approach to understanding the risks because of the volatility and uncertainty that the pandemic has brought about on a global scale?
Yeah, sure. That's a great question. So number one, like we don't try and predict, which is the good thing. But what we do when we are, for example, using our tools in assisting clients, we go beyond just the current levels of volatility and neutral skew. So typically what I will do is take like a high, low, and a mid volatility and a negative, zero, and positive skew, and I'll evaluate the strategies against all 9 different scenarios. And that really points out weaknesses in strategies that work well in some market scenarios and not in others. And especially in things like the heightened volatility, which we certainly saw back in 2020, that's always been one of the things that we look at, and that will affect the strikes and such that we do when we are actually setting up the strategy. So we might tweak based on, initial simulations under high vols. We might move around the strikes or use different option strategies to be more robust against high vol.
As far as the sort of development of those strategies, so you're able to use the spot markets and understand sort of what is the price of this currency at this particular point in time. And I'm wondering if you can talk through some more of actually the sort of next steps after you say, this is the potential, upside, potential downside of this particular strategy, and then being able to guide your clients in making those decisions. And then, once they have made that decision, going back to understand what was the actual output and being able to, use that to inform future decisions for risk mitigation.
We've gone through several cycles where, we've been able to put a strategy into place, watch it play out, close it out, and get the P&L, for both the exposure and the strategies. And, in general, what we've done is held up very well. The only thing is that conditions are always changing. So I'll give you an example. Last year, during the pandemic, interest rates dropped worldwide, right? And so the cost of various hedging strategies like forwards were almost negligible. And so in a high vol environment where the cost of hedging is low, it was pretty easy to do no wrong. But then we close those out, and now we're in 2021 and interest rates are rising. And so these strategies for their rolling hedges or new hedges are changing based on the new market. So it's a constant evolution based on all of the different financial factors that come into play on the derivatives market.
And again, speaking in terms of current events, there's the question of rising inflation, at least in the United States. And I'm curious how things like inflation within different countries impacts the overall risk at the financial exchange layer, where you might have a certain amount of currency where the exchanges between currencies are at a certain point, but the actual purchase power of that currency within the bounds of that country is impacted because of the inflation rate.
Right. Yeah. So inflation is a small piece of why spot rates move. It really is truly a supply-demand question. So, why does a dollar rise against yen or euro, or why does sterling rise against South African rand? If a country's economy is very strong, people are investing in it and buying their products. And so I need to exchange my dollars for, name the country, rand. And conversely, if I'm selling my dollars, then that depresses the market for dollars, increases the market for rand. So those are some of the forces. Other forces are the interest rates. And this is where the inflation bit comes in. So central banks around the world, they've got several mandates usually, but one of them is to keep inflation, in some certain band, say 1% to 2%. And when it moves out of that, then they need to start pulling levers. And so they will pull the interest rate lever. as is happening in Brazil, right? They've got pretty bad inflation, and so the central bank is raising interest rates. What that does is generate what's called the carry trade. So investors will sell low yielding currencies and buy high yielding currencies and make money off of the differential interest rate. And so now I'm buying reais, that increases the value of reais. The spot rate, moves in reais favor. So that's how inflation influences interest rates, which influences spot rates. Yeah, lots going on. Yeah,
absolutely. They're interesting and complicated beasts, and I'm wondering sort of what your educational path has been moving from the engineering into the financial markets. Once you started going down that rabbit hole, what were some of the approaches that you took to being able to understand more fully the market that you were working in and the constraints of the problem domain that you were trying to solve for?
Thank God for Dr. Google. There was years of lots of study on just what drives these things, reading, everything I could. I'm an avid consumer of The Economist magazine. But yeah, it was a self-driven, not a formal education at all, but working with the banks, in getting derivatives set up for clients, and, also just Bloomberg, is kind of the basic big source of raw data, market data, like what spot rates, what, option premiums and all that kind of stuff are. And so kind of a deep study of how those things are put together and how they relate to each other. It's continual education. You can't ever stop, basically.
Same thing with being an engineer. So
yeah, and that's the fun of it, right? I mean, if there was no more learning, I'd be pretty bored.
Exactly. And speaking of newer developments, particularly in the financial industry, I'm curious what the impact of things like cryptocurrency and decentralized finance has been on the sort of potential strategies for risk mitigation and currency exchange, and how that might contribute to various elements of volatility or even potentially act as a stabilizing factor for certain currencies.
I will divide that question into two parts. One is blockchain and the other is cryptocurrency. Blockchain I see as quite a valuable tool, especially with Ethereum and smart contracts. There is definitely a role for smart contracts to play in this space, in hedging and in cross-border transactions of all kinds, self-executing contracts. For example, contingent hedging, something I've been working on where, if let's say you've got a cross-border M&A, right? You're about to buy this company, but you got to do 3 or 4 months of due diligence. You agree on a price up front in your currency and theirs, and of course, the next day it's different, right? So 3 months from now, what will the price be in each currency? That needs to be hedged. But if the deal doesn't go through, that eliminates a number of different derivatives that you might have used. And so developing an alternative method, which is what I've been working on, is badly needed in this area. And connecting that to smart contracts so that in the beginning, at the inception of the M&A, both parties could enter into that smart contract, and based on the outcomes of the due diligence, then the deal could go forward or not, and currency is exchanged or not. So blockchain, definitely, I believe so. Cryptocurrencies themselves, I personally don't think they're ready for prime time for a lot of reasons. Number one, from an environmental standpoint, they're a disaster, from their power consumption. Number two, as a store of value, they're a disaster because they're probably the most volatile thing out there. I mean, they make the Argentinian peso look stable. And so as a store of value, they're a complete failure. And, for countries, what was it, El Salvador? Was that the country that decided they'd accept crypto? I think so.
I think it might have been one of them. I think Colombia might be another.
Yeah, very, very bad idea. And here's why. I mean, when a country issues its own currency, its central bank has a lot of leverage to pull in terms of devaluing or making more valuable their currency. And so managing their inflation, managing their exports and imports, because they can control their own currency, then they have those levers. With crypto, they've got no levers at all. And so, they basically give up a lot of really important control for a country's economy. So from those three contexts, I don't see it entering into the big picture. Plus, lastly, because of the computational load, was it 7 or 10 transactions per second? I mean, it's some pathetic number that wouldn't even handle the smallest country in the world, right? I mean, to scale that up so that you can handle the trillions of exchanges that happen every day worldwide, there needs to be a different way. So The main answer is no.
It's a good answer. The answer to cryptocurrency is no. Doesn't matter
No.
the question.
You can quote me on that. I'm prepared to back it up.
And so in terms of the tools that you're using and the sort of mathematical principles that you're building on top of, what are some of the areas that you're working in where the existing tools or the established practices are insufficient and you have had to either build out your own capabilities or develop new algorithmic approaches or decide that, a potential risk mitigation strategy is not worth exploring because it's too sort of computationally complex or, you have insufficient confidence in the results that you're generating?
Yeah, there's parts of that I can answer and parts that I really don't have an answer for. I would say the biggest problem with bringing math to finance is, it's not physics. There's humans in the loop. And, there's all of the elements of behavioral finance, right? Biases and stuff that creep in. The efficient market hypothesis is the foundation of a lot of math and finance, and it's proven completely bogus, right? There's no efficient market. I mean, if that was the case, then, you wouldn't have market crashes, you wouldn't have stock market circuit breakers, all that sort of stuff, kind of makes a mockery of the efficient market hypothesis. And so, when you make assumptions like we do, that things are normally distributed and that, the kurtosis is right around 3 and there's no fat tails and that kind of stuff, it simplifies the problem enough so that we can talk about it and work with it. But it also does not provide, for the things that that happen. I mean, you look at, Taleb's, black swans, writings, and it's completely true, right? I mean, it all works fine until it doesn't. And that's where a lot of tools that we have break down. And I frankly don't have a lot of answers for those, because when they really, really break, like they did in, 09, 10, you get into the area of counterparty risk. So, I can enter into a contract with a bank to exchange a certain amount of currency in the future. But if that bank goes under, they're not going to honor that and I'm stuck. And so that's where the tools don't handle everything that the market can throw at them. I frankly don't have an answer for those situations.
Yeah, your response about the being able to properly model the market, the humans in the loop, there's the famous quote of, all models are wrong, but some of them are useful.
That's exactly right. Whose quote was that? I forget. But yeah, that's exactly right. When things are running along smoothly, all of these things work really well, and then they don't.
So for people who are interested in understanding more about this space or potentially getting involved, I'm wondering what are some of the useful resources or references that you would recommend, or specific sort of background knowledge or capabilities that people should have?
Yeah, so that's a great question, because as I'm sure all engineers are fans of lifelong learning. So some of the resources that I've used around Python is the SciPy convention, the annual SciPy convention. They have all of their stuff on YouTube. And so I've watched bazillions of hours of SciPy convention presentations, and they're exceptionally valuable. There's a number of kind of continuing resources like RealPython, which I subscribe to as well. And they give you kind of a weekly newslettery thing about the latest releases, or here's a new function you might not have thought about. The one I think that's nearest and dearest to my heart is there is a YouTube channel called 3 Blue, 1 Brown. I don't know if you're familiar with it or not, but of course my wife runs from the room when I put it on the TV, but it's Grant Sanderson's channel, and he makes math spiritual, beautiful, instantly graspable. He's got sessions on, linear algebra. He's got stuff on calculus. He's got stuff on crypto, and he makes it all accessible with the most incredible, not simulations, animated graphics that bring all these concepts to life. This is like you immediately get it in your gut. Oh shit, that's what an eigenvector does. Okay, now I got it. I never got it when the prof told me about it, but now I get it.
In terms of your experience of working in the space and developing your own methods and discovering other people's methods, I'm wondering what are some of the most interesting or innovative or unexpected strategies or techniques that you've seen applied to this area of risk management?
I guess something that I don't use or don't need to use, but I find fascinating, is sentiment analysis. So there's risk managers and there's traders, right? Risk managers try and take all of the beta out of everything, right? So if nothing moved, we would be successful. Whereas, people that are trying to extract alpha out of the market, they're not like us. And I'm sure that, the sentiment analysis is one of their huge tools, and being able to scrape the web across all news and social media channels to kind of get an idea about whether to be bullish the euro or not. To me, that's really, really interesting. And if I was in that space, I would kind of be all over that.
In your experience of working in this space, what are some of the most interesting or unexpected or challenging lessons that you've learned?
Explaining what I've done to fund managers. When I first started working with fund managers, I was full of trepidation because I was like, oh shit, these guys are really smart and they're making hundreds of millions of dollars and, probably talking, kindergarten to them. And it was the other way around. And, statistics and violin plots or box plots, man, you'd had to hold their hand through the thing. I mean, once they get it, they definitely grok it. But that's been one of my biggest surprises, is their unpreparedness given the amounts of money they're moving around and the things they're doing.
Absolutely. And so in terms of the work that you're doing going forward, what are some of the economic and industry trends that you're keeping a close eye on, either for your own personal projects or for the work that you're doing with Diaglo?
Yeah, so one of the things actually that I've just recently started digging more deeply into is metrics and benchmarks. So, when a fund is, pitching itself to investors, they talk about their past performance, and they use terms like internal rate of return or MOIC, which is basically a capital multiplier. There are now a number of new measures, something called PME, public market equivalent, which is basically, if I had invested in the S&P 500, would I have done better than investing in your fund, right? So there's some new metrics, and getting the data to calculate those, and some of its variants like direct alpha is something I've recently been digging into, because one of the things that we need to do when we're running back testing is to use the metrics they're interested in so that we can show how our strategies would have performed against the metrics that they are actually using.
Are there any other aspects of the work that you're doing at Diaglo or the overall space of FX risk management, or your experience of, building these systems and algorithms to be able to understand financial markets that we didn't discuss yet that you would like to cover before we close out the show?
I can't really think of anything right now other than I really love what I get to do because I get paid to think, and I don't think there's a better job. So that's pretty much it.
All right. Well, for anybody who wants to get in touch with you and follow along with the work that you're doing, I'll have you add your preferred contact information to the show notes. And so with that, I'll move us into the picks. And this week, I'm going to choose a movie that I watched recently called The Vault. It's an interesting heist movie. One of the main protagonists was an engineer, and he was hired on to this crew to be able to figure out how to counteract this very sophisticated vault to be able to, get the contents from inside of it. So it's a fun movie, not quite your typical heist movies. There's a little bit more sort of physics and thinking involved. So it was a fun film to watch. So definitely recommend that if you're looking for something to stay entertained with. And so with that, I'll pass it to you, Paul. Do you have any picks this week?
I'm taking my motorcycle to the Grand Canyon for a week-long tour of the North Rim. And I'm going to be trying to avoid every paved road and stay on the trails alone and be by myself. So that's what I got coming up. And I've been planning all the mapping and stuff for that.
It sounds like a fun trip. Hope you enjoy it, and definitely stay safe out there.
All right. Thanks.
All right. Well, thank you very much for taking the time today to join me and share the work that you're doing at Diaglo and your experience of doing FX risk management. It's definitely a very interesting problem space, and appreciate all the time and effort you've put into your work there and the time that you've taken to share your experience with us. So I hope you enjoy the rest of your day.
Thank you very much, Tobias.
Thank you for listening. Don't forget to check out our other show, the Data Engineering Podcast, at dataengineeringpodcast.com for the latest on modern data management. And visit the site at pythonpodcasts.com to subscribe to the show, sign up for the mailing list, and read the show notes. And if you've learned something or tried out a project from the show, then tell us about it. Email hosts@podcastinit.com with your story. To help other people find the show, please leave a review on iTunes and tell your friends and coworkers.